Welcome. So in this session, we are going to be looking at how we can use model portfolios on Bharosa Club. So let us start by trying to understand how these model portfolios were constructed and how we can use them. So I'm in the model portfolio tab, and what the text here, it says that Bharosa Club has done research and all that and how it selected them. And also it says that you could use different components or you could change the percentages depending on your risk profile, your circumstances and things like that. It's also clarified why it has only mutual funds from one fund house, and that it is an RIA, Bharosa Club, so it cannot get any commissions for recommending whatever it recommends. So the reason why it has all these funds from Axis Mutual Fund House only is because they have been performing quite well. And if all the funds are from one fund house, it becomes easier to transact because you can just log on to their website and transact, and you can switch between funds and if you want to rebalance your portfolio at a certain point in time. So for all these reasons, Bharosa has recommended these, and it's going to continue monitoring these model portfolios. So if a component doesn't perform quite well, and it's not in the top 20% of those type of components, then it's going to replace that with another component. So this gives you an idea of the thought behind how these model portfolios were constructed. Now let's look at each of the model portfolios. And so if you see the small case portfolio, and some of you may not be familiar with what small cases are, but they are like mutual funds, except that they are managed either by the small case research team themselves or by publishers who have their own small cases which they've published. So in effect, they are like the fund managers for those particular small cases. And at least recently, small cases have been performing better than mutual funds. So you can take a look and see whether small cases are right for you or mutual funds are right for you. But the bottom line message, which you can also see in my previous video about curing fixed deposit disorder, is that whether you use small case or mutual funds to cure fixed deposit disorder, you should use one of them. Now also for the small cases, you need to have a demat account and a brokerage account. So it's a little more complex than mutual funds. A lot of this is covered in this FAQ here. So you can have a look at that. And if you have any other questions, you can write to Bharosa Club at advisory@bharosaclub.com. Okay, so let's see the small case thing. And each of these, this is a link, so you can go to the page of that particular small case and investigate it further. So what we're saying is that 40% of your money should go into a low risk small case, and 50% should go into a moderate risk, and 10% should go into a high risk. Now, this is for a person who's neither very risk averse nor highly aggressive. So in the middle kind of thing. So if you are highly risk averse, then you could increase your low risk, reduce your moderate risk, and not invest anything in the high risk. While if you're very aggressive, then you could reduce your low risk and invest more in the high risk or moderate risk. So that is how you would construct your own portfolio using the inputs in the model portfolio. Now you could also do your own research and use different components than the ones which are suggested here. But if you do not want to take all that trouble, then these are good defaults to use. Okay. Now, what you'll see in the all-weather investing, if you research it, is that almost a quarter of the money that you invest is put into an overnight fund, which is basically the liquid Bs, which are ETFs, which invests in overnight funds, which are very, very safe. So these are monies which are parked with the Reserve Bank of India. They're not lent out to anyone, and they're just kept for one day and then reinvested. So there is no interest rate risk, there is no credit risk, and these are as riskless as you can get. Okay, so also if you have need for money, then you can always withdraw from the all-weather investing, the safe part. You can cut down your proportion of liquid Bs and withdraw money. So, you do have liquidity, and as long as you do not need all the money that you have invested, then this is as safe an option as fixed deposits. So remember this, that you should not invest all your money in these model portfolios unless you are able to say that, okay, at the maximum, I'm only going to need 10% or 20% of your money to cover your emergency needs or short-term needs for liquidity, right? So with that caveat, because what we wanted to show was that these model portfolios provide better liquidity because there are no lock-in penalties, and that they basically also have good liquidity and good performance, and are also tax efficient. So as far as taxes, if you do not redeem any of these, you do not pay taxes. And on the redemptions, you pay either a 15% tax on short-term capital gains if they are equities. If they are debt, then you pay the normal rate. And if there are long-term capital gains on equity, then the first 1 lakh you pay nothing, and then above that you pay at 10%. Now for debt, for long-term capital gains, you get the benefit of indexation, though the long-term period is 3 years, and you pay tax on the gain after indexation at 20%. Okay, so this is just to reiterate that these are very, very good options. In some cases, like in the equity funds, like the Axis Blue Chip Fund and the Axis Mid Cap Fund, if you don't hold the funds for a year, there may be an exit load, but still you can get out of them at any point in time if you want after you pay the exit load. It's also been mentioned at the end that if you need a fund for tax saving for ATC, then you could look at the Axis Long-Term Fund, which is a pretty good, well-performing tax saver fund. Okay. So with this, let us see how the model portfolios have done. So let's go to the performance page. So the first part of the performance page is really just the Bharosa Top 150 small case, which is a component of the small case portfolio. So we won't spend time on that, but you can look at it yourself. And it's basically done quite well. It has outperformed the index. It's almost completed 1 year on 8th August 2020. It will complete 1 year, and it has beaten the index by 18.08%, and it has given a 19.48% return over this 1 year, which is quite outstanding. Now let's move to the mutual fund portfolio, the model mutual fund portfolio. So how is it done? Actually, before we go there, I'm going to go back and explain to you a little bit about why the Access Overnight Fund was chosen. Now, the Access Overnight Fund for 20% of your money. So we said that when you go into low risk, you want to worry about safety and not about return. Okay. So even in that all-weather investing in the small case, around 20% or a little more is in the overnight funds. So these are very low risk and they give very low return also compared to other alternatives. So I think the thought that Bharosa Club had when they chose the overnight fund was that if you want to take more risk, then you can take it in the moderate risk and medium risk categories and don't take it in the low risk categories. So don't take it in, say, gilt funds or PSU bond funds or ultra short-term debt funds or the wide plethora of debt funds which are there because they also have moderate risk and they don't have low risk. Okay, so that's the reason for putting in the money in the overnight fund. There you'll also see gold there and a 10% weight to gold because gold is considered a good hedge. And then because of all this stimulus due to COVID-19, for the next few years, gold could perform quite well. But we still put it as a medium risk fund. And then you have the Nifty 100 fund, which is an index fund. So that is essentially where you have passive investing and you don't have active investing. So we've called that medium risk. The Access Blue Chip Fund, because it invests in blue chips, though it's actively managed, is again a medium risk fund. And then the mid cap fund, because it invests in smaller stocks and mid cap stocks, is a relatively higher risk fund. So it's a high risk fund. Okay. So now let's get back to performance. And on the performance, what you will see is that the mutual fund portfolio, the model mutual fund portfolio over 5 years has done better than fixed deposits by 2 percentage points. In 3 years, it's done better by 3.5 percentage points. And in 1 year, it's done better by 5.7 percentage points. Now, there is a period over the last 6 months, okay, where you had the meltdown or the market meltdown, where due to COVID, where fixed deposits did better by about 2.41%. But if you look in the last 3 months, because of the recovery, it's done much better than fixed deposits at 9.52 and 5.71 over 1. Right, so this gives you an idea of how the, and this is updated every day when the markets are open. After the close, the next day it's updated. So if you are a member of Bharosa Club, you can come back and have a look at the performance anytime you want to. Okay, so let's see how the small case portfolio has done. So the small case portfolio over 5 years has done 13.34%. So it's beaten by 6.31. Then over 3 years, it's beaten by 3.29, which is slightly less than what the mutual funds have done. And in 1 year, it's beaten a lot by 11.99. And then in the 6 months, it's down less than the mutual funds. But in 3 months and 1 month, it's done worse than mutual funds, right? So what can we learn from this? So it looks like small cases are not a bad choice from a performance standpoint, but the performance does vary. So whatever you are more comfortable with, you can choose. What you have to realize that in these charts, both in the small case and in the mutual funds, because some of the mutual funds had shorter operating histories than 3 years and 5 years, and some of the mutual funds have been launched relatively recently. So there has been the use of backtest data in computing these things. But I think one thing is exceedingly clear that in the past, both the model mutual fund portfolio and the model small case portfolio have outperformed fixed deposits by a lot. So the logical question to ask is, yes, that's the past, and the past 5 years, 2015 to 2020, have not been absolutely stellar years from an economy standpoint. The economy of India was slowing even prior to COVID. It also includes the COVID period. So you can ask yourself, will the next 5 years be better or worse, right? And if they're going to be better, then the chances that these model portfolios will outperform fixed deposits are even more. If it's going to do much worse, then the outperformance may be less. So in my personal view, it has been, it's very clear that the last 5 years were not spectacular, and the next 5 years are likely to be better than the previous 5 years. But that is a personal view, and you will have to make that choice yourself, right? So that basically shows you how the performance is done. Now the question is, how do you execute these, and what should you do in terms of monitoring? And then some of the improvements which are possible, which Bharosa Club might work with Access Mutual Fund and Small Case to do. So right now, if you want to buy these small cases, you have to buy them individually by going to the small case website and buying them. And for the Bharosa Club small case, you have to pay annual subscription fee of 1180, which includes GST. So you have to pay that once a year, irrespective of the amount that you invest. So there are some mechanics involved in actually buying these, and then you will have to do the calculation of this, the percentage, the 40%, the 50%, and the 10% yourself. So you will have to use Excel or something saying, if I want to invest 5 lakhs, then how much should I put into 1, 2, and 3, right? Now for the mutual funds, you could go to the Access Mutual Fund website and again do the calculation and then invest however much you want to invest in each of the individual funds. You have to invest in each of the individual funds separately. Now, also, it may be a good idea that once a year, you should look at your portfolio, because when you started, you had a certain set of weights, and because of market movements, these weights may have changed. Now, if they've changed a small amount, like say 50 has gone to 53% or something, then probably you don't want to touch it and let it ride. But if it's the variation is more than 5%, you may want to rebalance, and that is basically sell to get it back to 50% and so on. So then you can do this whole calculation again, and then do the needful. So this rebalancing also is not automatic. And the last part in small cases is that once a quarter or once a month, the small case fund managers rebalance the portfolio, their small case. So you get a message there, and then you have to execute that rebalance with a single click yourself, but you have to go through certain steps. So in also the minimum investment amounts that you need to invest in the small cases are slightly more. They're about $1,20,000 or so and they keep varying. But for the mutual fund portfolio, you can get started if you want the exact proportions with like 50,000 rupees, because 10% goes into the mid-cap portfolio, which has a minimum investment of 5,000. So there are all these little bits of complexity which are there, and unfortunately, at this point, we cannot claim that the model portfolios are as simple to use as fixed deposits. Now, if small case and Access Mutual Fund were able to innovate and even talk to regulators, because some of these will need regulatory approval, like not having to do rebalancing yourself, but being able to give the authority to rebalance to, say, small case or the publisher, the small case platform. These cannot be done without regulatory approval. And there are a few other changes, like in terms of how do you lower the minimum, maybe down to like 100 rupees. But if you lower that to 100 rupees in the case of small case, then you'll need processing for fractional shares, which again requires regulatory approval and some platform changes, maybe even at the brokerage level. In the case of mutual funds, they don't like very low minimums because their earnings are subject to how much money is there in the funds, and the cost of processing could be pretty high. But again, with innovation and regulatory changes, this could be changed. So a couple of things that small case and access mutual fund can look at in terms of innovation, and then use RIAs and other distributors to distribute these widely so that more and more people end up using small cases of mutual funds rather than staying stuck in fixed deposits. So what are these? To summarize them, the first is lower the minimums so that it becomes very easy for people to invest and try, maybe with even as little as 100 rupees. So then 50 rupees would be invested in, say, Axis Blue Chip, 10 rupees in Axis Mid Cap, 10 rupees in the Gold Fund, 20 rupees in the Overnight Fund, and 10 rupees in the other fund. So this thing is certainly doable. The benefit of doing it is that it becomes inclusive. And if we are worried about financial inclusion, then rather than just say that we are concerned about financial inclusion, we need to act on this. The second thing is that the user would like, both from an adding point of view and from a redeeming point of view, the ability to add or redeem by just putting in one amount. And then the system at the back should take care of all this allocation and so on and so forth, and not have the person have to make all these calculations. And finally, if the system, the user wants to give the authority for rebalancing, say once a year, then again, it should be done automatically for them. And when those individual small cases are rebalanced, they shouldn't have to do anything. So then it will become as close or maybe even better than fixed deposits in terms of simplicity and a set it and forget it. So let us see whether any of these innovations happen. But even before these innovations happen, if you are a user, I hope you will use these model portfolios to basically push up the rate at which your investments compound, which I've explained in detail in the other video on curing fixed deposit disorder. Thank you very much for listening to me.